What's up YouTube? Welcome back to another video. Today I'm going to be going over my Google investment thesis and reasons I'm adding Google to my TFSA. Google was a company I was very on the fence about due to the market share and moat concerns, but after doing a full deep dive into the company and doing a lot of research, I've come to find that their market share as of now is still very strong along with their moat. To start off the video, I'm going to be quickly going over their latest Q1 2025 earnings. So if we go down to their revenue statement, or income statement, sorry, their total revenues grew 12% year over year. Total cost and expenses grew 8% year over year. Income from operations grew 20%, and total net income grew 46%. Now, I do want to mention that their other income and expenses grew 293%. Now, this is mainly because their other income and expenses was 11.2 billion, as we saw in the slideshow, primarily due to an unrealized gain on our non-marketable equity securities related to our investment in a private company, which we noted in our 10K as a subsequent event. Now, I don't see this as this was not involved in my investing thesis. This is kind of a one-off thing that they're recognizing a unrealized gain on one of their investments in a private company. So this is most likely going to be probably a one-off thing. I don't see this being a reliable metric in the future, counting on another $11.2 billion. So that does kind of fluff up their net income this quarter. So I personally will be watching for that. If there is something crazy like 293% growth in other income, I'll definitely be looking into their SEC filings to why that's the case. And then their diluted earnings per share grew 49% this quarter. Scrolling down to their revenues and operating income, again, 12% year-over-year growth, and their operating margin increasing to 33.9 from 31.6. And if we keep scrolling down, their cost of revenues and operating expenses slide. For their cost of revenues, it grew 8%, and their operating expenses grew 9%. If we go back to the transcript, their CFO says here, other cost of revenues was 22.6 billion, up 9%, with the increase primarily driven by content acquisition costs, largely for YouTube, followed by depreciation and other technical infrastructure operations costs. Then he also says total operating expenses here. R&D increased by 14%, primarily driven by increase in compensation and depreciation expenses. Sales and marketing expenses decreased 4%. General and administrative expenses increased by 17%, reflecting the impact of charges for legal and other matters. Going back to the slideshow, we see their total cloud revenue grew 28% year over year. So their cloud revenue is continuing to ramp up, as well as their operating margin on income is almost doubled year over year, going from 17.8% to 9.4%. So as Google Cloud continues to become a larger part of their business, I do expect their margins to keep increasing, and hopefully the revenue will stay around the high 20 range. I'll have to watch on that, as just keep a close eye whether or not it starts to decelerate. Then we can see capital expenditures up 43% this year to 17 billion. And then lastly, their trailing 12 months free cash flow slide here. Net cash provided by operating activities up 25%. Purchase of property and equipment up 43% to a $17 billion loss. So they are still heavily investing in their properties and equipment for their infrastructure. Free cash flow up 13%, and trailing 12 months free cash flow up 8%. Throughout the course of the year, I do expect Google to continue heavy spending in CapEx. as they've said in their annual report that a lot of this spending will continue to hurt their profit and loss statements, as they expect the growth rate in depreciation to accelerate in 2025 as they put more technical infrastructure assets into service. As time goes on, I will be keeping a close eye on their return on capital employed, just to make sure that Google is actually profiting from all this spending. So after the earnings report, it had me very intrigued, and I continued to look further into the company and found their quite incredible balance sheet. Their total assets grew to 475 billion, up from 450 billion, mainly driven by property and equipment as well as non-marketable securities. So their long-term assets growing was something I was very happy to see, as well as their total current assets sitting at a healthy 162 billion. Now, if we look into their liabilities, they're only at 130 billion, which means if they needed to, they could pay off their entirety of their debt just with their cash and cash equivalents and other current assets of 162, and they would still have around 30 billion to spare just in total current assets without even having to touch their long-term assets, which is something I was quite happy to see. One of the things that really held me back from investing in Google was a lack of knowledge about the company as well as the potential for disruptors like ChatGPT potentially threatening their market share. What really helped ease my concerns on their moat was their recent Google I/O event. With their recently introduced AI overview you get with the Google query, they have also now prepared for launch of full AI mode using their Gemini AI models. This uses Gemini to answer more in-depth questions the same way ChatGPT would, but with Google's database to help better answer and solve your questions based on your search history, Google reviews, and other information that they have. If you decide to enable it for a more personalized answer, they did say in the conference that this was if you enable it, so you can turn that off if you don't want AI to kind of go through your search history and whatnot, which is a nice privacy feature. As well as that, they also are introducing advanced AI video building softwares and other upgrades to devices, cloud, and web services. I'll leave a link in the description for their I/O conference that they showcased. They showcased some really cool things, I think, and as a Google investor, I think it's definitely a must watch. During their 10K report, a common theme and dialogue I saw was that they say, we face intense competition. If we do not continue to innovate and provide products and services that are useful to users, customers, and other partners, we may not remain competitive, which could harm our business, financial condition, and operating results. Now I'm going to draw a bit of a comparison to Uber here. It may or may not be good, but that's kind of what I'm thinking of is they're not shying away from like with Uber, they're not shying away from innovation with autonomous vehicles. They're actively creating partnerships with the likes of Google's Waymo, along with other AV innovators. They're using technology to further widen their moats and market share instead of being scared of it. And I do think that's exactly what Google is doing and has done. When TikTok and Instagram Reels really started to take off, Google made YouTube Shorts to help their moat. And now with ChatGPT, they're innovating and improving upon their Gemini AI models to keep up with their surroundings. But where I think Google really has the edge within the AI space is how much data they truly have. Within their 1.5 billion monthly active users from queries, each query helps build their database and training models. Along with the monthly active users, they have a huge range of other data and analytics outside of queries that is helping them train Gemini as well. So I really don't think Google's moat or competitive edge has been disrupted at this moment in time. Obviously, going forward, I will be keeping a close eye on revenues, especially from their Google Services revenue, as it does make up a majority of their income stream. With it only seeing around 8 to 10% growth every quarter, if that really starts to decline, it could harm their overall business. That being if they don't keep diversifying income streams from other sources like their Google Cloud segment. So overall, I'm very happy with what I researched or what I found from my research. And being it only at the 171 mark with a price to earnings ratio of around 18.7. I do think Google is quite undervalued. If we compare it to another tech giant in the Mag 7, like Apple, their price to earnings ratio is 27, and their revenue has basically been flat over the past 5 years. So with Google's revenue continuing to grow, whereas Apple's is flat, I am looking for an exit opportunity in Apple, and most likely will be reinvesting that into obviously Google, as I do think Google has more of an edge going forward with their growth prospects. Apple hasn't really shown any advancement in AI. It's all talk, and they don't actually show anything and give anything to their customers, whereas Google is constantly innovating and introducing it quickly. So yeah, overall, I do think Google has a better outlook than Apple. And with Google's valuation sitting at 5-year lows, I do think it's a great opportunity for me to keep buying into this. I will be trying to add as much as I can, up to around 8% of my TFSA in this 171, like low 170s, high 160s range. So that'll be it for today. I hope everyone enjoyed and got something out of it. Feel free to like and subscribe if you so please, and I'll see you in the next one.